New year, new headaches? Well, for Jerome Powell at least. Does the legal action around the Fed and a new era of populist government spell the end of central bank independence as we know it? And even if it doesn't, what are the implications of all this noise for financial markets in the months ahead? Welcome to Fidelity Answers. Hello, I'm Seb Morton-Clark, and this is the series where we tackle the questions investors are asking of the people managing their money. This month, what will falling US rates mean for my portfolio? Because whatever happens with the Fed, it seems that financial repression is the name of the game for US economic policy. Fight inflation, but don't fight it with interest rates. And that's going to have big implications for global markets and the risks investors decide to take. Becky Quinn is a portfolio manager in Fidelity's multi-asset team. So just the person to debate what assets you might want to be looking at in this new reality. Welcome, Becky.
Hello.
And if US rates are going to be loose, then top of the list of fashionable investments should be emerging markets. And fixed income fund manager Philip Fielding is here for a sense check on how that might go. Welcome, Philip.
Hello.
So let's start with central banks, Becky. To what extent is this row over independence likely to upset markets this year, do you think?
Thank you. If I may, perhaps take a step back and just to think about the concept of central bank independence, because we haven't always had it as we know it today. The Fed became independent really after the Second World War in the 50s. Prior to that, during wartime, the Fed was sort of tasked to monetize the debt generated by the government and keep the cost of borrowing for the government at an acceptable rate. But following that, we've seen belief in central bank independence to come in place and really got reinforced during the 70s, where, if you recall, we did see this period of phenomenal inflation, partly contributed by this pressure on central banks to keep policy a little bit too loose, even though inflation becomes stickier and more persistent. We know how it ended. Subsequently, very sharp rate hikes and period of recession. So great economic and financial pain for many investors and economic participants at the time. And so we then now believe that the freedom for central banks to act, to pursue their own goal of long-term price stability, free of the interference of governments, is really important, evidenced by those periods, but also, based on this belief that there's a fundamental mismatch between the central bank's goals, which is long-term price stability, versus those of the government, which is driven by the election cycle. So back to the point that you made earlier, this attack on central bank of Fed credibility from the current administration, this pressure for the Fed to essentially cut rates, buy assets, even though against the backdrop of we had decent economic growth and inflation is still above target. Investors are asking the question about, where should the risk premium on the treasury be? Where should the valuation of the dollar be? And that has led to bouts of volatility, which I doubt will go away anytime soon.
Are there other things that we should be worrying about when central bank independence comes into question like this?
How it would manifest in different ways, I guess for some it might work. So for the government, for example, higher inflation will work great for the high debt to GDP level by gradually eroding away that debt load, which is perceived to be, I guess, almost like the only way out, where the fiscal way to reduce debt seems to be unpalatable. However, for investors, real yield, so the real compensation on government bonds becomes negative. And so buying treasury or cash to go into the 40 of the 60-40 portfolio, suddenly you're not compensated at all. You're losing out as inflation stays sticky. So investors essentially have to rethink, in the steady state portfolio, the 60-40 work, what is the new 60-40? What is my defensive asset? And if I were at a stage in my life where I'm decumulating, how can I preserve the wealth that I've accumulated during my working life if I can't use cash or bonds to do so in a low risk way? I think these are all very pertinent questions.
Okay, so Philip, does this ring any alarm bells for you? Are there any parallels to draw on from recent examples in emerging markets?
Yes, it's interesting because we're in a strange paradox in a sense, because emerging markets in this cycle have done precisely the opposite of what Becky was just outlining. So they reacted to the inflationary pressures that built after COVID. They were mostly driven by supply side disruptions. So supply chains got mangled. It was difficult to supply the correct intermediate goods to the right manufacturing places. And we had an episode where inflation was really um, uh, way too high in emerging markets and in developed markets. And what was interesting during this period is that emerging market central banks have reacted to this proactively. So, for example, the Brazilian central bank hiked rates more than a year before the Fed reacted with their first rate hike back in 2021, 2022. So, for once, emerging markets are in some ways ahead of the curve. And if you look at inflation projections right now, in a lot of emerging markets, they're actually undershooting expectations. They're decelerating faster than developed markets. So, a lot of investors are finding emerging markets an attractive alternative in an environment where inflation appears to be stickier in developed markets, but in the emerging markets, it is decelerating.
Is it fair to compare other emerging markets with an economy like the US because of its sheer size? We sort of have to treat the United States in a different way, don't we?
Yes, I mean, the United States will always be a very, very important anchor for global demand. And in fact, demand in the United States is still pretty robust, it's pretty healthy, which is partly the reason why inflation is proving sticky. So, if, as we expect, and I guess most of our peers expect, the US is running their economy somewhat hot into particularly the midterm elections in November later this year, then this demand boost that benefits a lot of emerging markets is probably here to stay in 2026.
How do you see this playing out over the next few months?
In terms of the inflation dynamics in the US and growth outlook of the US, we're still looking at a world where growth is probably going to be reasonably resilient, like Philip already mentioned, because after all, we still have the fiscal policy. And likely monetary policy, especially with the new Fed chair, as a tailwind. So macro environment is probably still going to be relatively pro-growth, if not a little bit reflationary. That could be argued to be positive for the dollar, but this loss of credibility and constant geopolitical tit for tat is creating and reinforcing this sort of weaker dollar trend that we've seen last year. We still think the prevailing weaker dollar trend is probably here to stay. Investors can still allocate away from dollar from historical high allocation levels and hedge a little bit of more of their asset. And so this trend should still be quite supportive for emerging market assets, especially local currency, which is one asset class that we've liked last year.
Thinking about US policy for the coming months, potential impact on the dollar, what does that mean for developing economies that you're looking at, Philip?
Yeah, that's an interesting question, and I think the case was well made for the dollar to likely stay relatively weaker over the next few quarters, and perhaps even into the medium term. And that is typically a very good environment for emerging markets. If the dollar starts to substantially weaken from here, in trade weighted terms in particular, for most emerging markets, it tends to be a boost. It makes things easier. It makes it easier to fund the needs in international capital markets. It makes it easier to to fund current account deficits if they exist. And what we are seeing in this environment right now is, for example, that a lot of external vulnerabilities that existed in previous cycles are not so prevalent in emerging markets. So we don't have emerging markets with outrageously large current account deficits, for example. There was even a term coined in the previous episode, the so-called Fragile Five, where we had five large emerging market economies with large current account deficits. We don't see this at the moment. We think that external sectors are relatively healthy, and we think that even though currencies have had a pretty good run, emerging market currencies had a pretty good run in the last 12 months or so, they look by no means overvalued at this stage, because actually we're coming off essentially a 15-year long dollar bull market. We've only just started to see the turn of the dollar.
So, Becky, if we accept that we're settling into this period of financial repression where inflation runs hot compared to interest rates, how does that influence what you're putting into portfolios this year?
In an environment where we want to seek real return and protection of wealth, I think within the fixed income space, you probably want to, instead of buy long-dated nominal bond in the US, which could be, subject to risk of higher term premium or be threatened by inflation, you probably want to have some inflation-linked bonds or real high real yield bonds, such as currency bonds, there to broaden out the portfolio. And really, I think beyond fixed income, in the in the equity portfolio, I think remain invested in equity is still quite important. Equity is a real asset, and you would imagine in an environment where earnings is still quite constructive, investors need to have some allocation there. Within that, to be honest, the question we frequently get challenged on is, well, but don't you know equity valuation is high? Don't you know there's an AI bubble? How could I invest? Don't you know the market is very concentrated? I think there we're just looking for diversification of styles. For example, seek better valuation to broaden out into mid cap value style that can benefit from the reflation story, or to play AI without just owning the tech sector, because we know there are winners and losers, and we're already seeing the Max 7 diverge and software really suffer. You could argue that the advancement of AI has really taken on a new pace, and many software business models are at existential threat as well. And so, instead of just buying the broad tech sector, be a little more selective, or play AI via the bottlenecks, which is what we've really liked. So the materials or the energy utilities. The what is required to continue to carry out this very ambitious AI capex. And finally, I guess what I talked about, the sort of suitability of 60/40 in the portfolio, I do think the concept of hedging assets is different versus pre-COVID, where we could rely more on bonds, and now we need to think harder. It is buying volatility, perhaps, that can reliably protect you, or precious metal, for example, in a more inflationary world. So having a portfolio that can cater for more inflation volatility is quite important.
And geographically speaking, where are you beginning to look more closely?
We still like the US stock market. I think a strong US stock market even can coexist with weak US dollar. So we can take exposure in those sectors that I mentioned that can benefit from a broadening out of growth. But looking beyond US, I think we quite like EM as well. Within China, we've liked the China tech sector, which also benefit from this policy support, but also has cheaper PE essentially versus their DM counterparts. And they still have attractive potential earnings trajectory given the strategic focus on that area. We also have liked the mid-cap space in China, just thinking that potentially policy gets a little bit supportive, maybe the growth start to slowly improve, and the sort of mid-cap, more domestic sector could benefit a little bit more. And I guess, I don't know if this is strictly speaking EM, but within Asia, we quite like the Korean stock market last year as well. So really to play that memory chip dynamic. So broadly in EM will look quite interesting in that weaker dollar and decent global growth environment.
So, Philip, this brings us nicely around to your wheelhouse. First off, how did emerging markets do last year? How did they do in 2025?
Emerging market debt as an asset class is actually the best performing asset class within all of fixed income, with emerging market local currencies topping the return table within, emerging market debt and then obviously fixed income. But emerging market hard currency bonds also perform pretty strongly, particularly on the sovereign side, with returns just under 15%. Local currency was up almost 20% last year. So emerging markets had strong returns last year, and we have seen an increased interest again in emerging markets from external investors and internal colleagues as well. But we feel that overall in global portfolios, emerging markets are still a fairly small allocation on the fixed income side in particular, owed to the very length of the dollar bull market. Those 15 years I mentioned earlier, it's just a very long period for investors to digest first, and we feel that this is now slowly happening, and we're seeing flows turning a bit more constructive towards emerging markets just over the last maybe quarter or two.
Is there an argument here that people might have missed out on this trade? If it all went well, so well last year, how much more room is there to run, do you think?
That's a good question. We get this question quite often because people fear that they might jump onto the bandwagon too late, and then the wagon derails. In our view, we're only at the start of this relatively structural dollar bear market. If everything that Becky says comes to pass, then this is pretty likely to continue, this relatively weaker dollar. And in fact, for emerging market returns to be constructive, we don't need the dollar to weaken significantly. Just a stable environment where the dollar doesn't rally suddenly is probably enough for emerging market returns to be comfortably ahead of developed market peers in an environment where developed fixed income is under pressure from higher inflation than previously and from fiscal largesse that ultimately leads to steeper yield curves in DM.
Interestingly, when I was sort of more philosophical question here, when I was researching for this conversation, I discovered that I'm actually about the same age as the terminology emerging markets. It's been quite a while, and I think the world has changed quite a lot in that time. And so, my question is that terminology still relevant nowadays? The term of emerging markets.
That is a good question, and unfortunately, I'm not a philosopher.
Give it a go.
But no, I mean, what we're looking at is basically dynamic economies in that actually are really diverse across many variables. So we're looking at really deep financial markets in certain countries where we have access to the currency, forward markets, interest rates, derivatives on interest rates. We have credit across well-diversified, well-defined sectors. To name a few, in Latin America, Brazil and Mexico. In Asia, we have deep and liquid credit markets and interest rate markets in, for example, China, in India, in Indonesia. We have in Africa a fairly deep market in South Africa. We have deepening markets in North Africa, Egypt, for example. In Europe, we have Eastern Europe. We have interesting opportunities in Hungary, in the Czech Republic. But at the same time, we have very, very shallow financial markets in Sub-Saharan Africa. For example, the bond markets of Benin are topical. They're going to issue a bond this week, probably maybe next week. They only have a handful of securities outstanding, no corporate sector, no local sector. In Asia, for example, in Pakistan or Sri Lanka just came off a restructuring. That's a fairly shallow market. In Latin America, we have shallow markets in Uruguay, for instance, in Paraguay, in Central America, also El Salvador, various markets like this that are really quite shallow.
Sort of global indices, have they changed at all over the last decade or so to recognize any of these changes that you're talking about?
Maybe the most significant change is that the main index providers have allowed the Middle Eastern issuers to come into the indices. They were previously not allowed due to relatively high wealth, but some tweaks in how these indices are composed were made, and then Middle Eastern issuers, which are actually prolific issuers, came into the indices and are taking up a fairly sizable share today. At the same time, we have seen shrinkage in Eastern Europe. So Eastern Europe, after the Eurozone debt crisis, were users of the dollar bond market in particular. because that was a deep pool of capital that he could access across, global asset managers that were keen to lend to Eastern European countries because they thought that, at the risk premiums offered, there's an attractive return opportunity there. But Eastern European countries, as they have progressed in the economic journey into the euro, in many cases, have decided to retire this dollar debt as it comes due, and not reissued in dollars, but reissued in euros or reissued in other currencies, and as a result, the share of Eastern European issuers in the main dollar indices has shrunk, but the share of Middle Eastern issuers has increased.
Some really interesting nuances there. Okay, what we're going to do is we'll take a quick break and dive deeper into one of those so-called emerging markets that you mentioned, and that's Brazil. Our producer, Patrick Graham, spoke to analyst Andressa Tezine about what promises to be a fascinating year for the country and its backers.
I'm here with Andressa Tezine today, who is a fixed income analyst on our emerging markets teams. Andressa, welcome.
Thank you. Thank you very much. It's a pleasure to be here.
Good. There's a presidential election in Brazil this year. What's going to happen?
Yes, this is the year for Brazil. So we're going to have elections in October. At the moment, it's very polarized. I mean, Brazil has become a very polarized country. The opinion polls are showing actually Lula is still leading. He's about 40%. But Flávio Bolsonaro, surprisingly, even though he was just nominated, he consolidated a very strong second place. So he's still tracking maybe 12, 13 percentage points behind Lula. But I think he's going to be really the candidate at the moment. And he's even calling for a unified right wing.
So there is some real risk of to and fro over the next sort of 8 to 10
Yes.
months until that election happens, because it's in October, right?
It's in October, the elections, but they need to nominate by April. So we're going to see actually the names coming up. And we're going to see already, Lula probably is the candidate, as we know. He always tried to not confirm still, but I think there's no other person for the left to have the same amount of votes as Lula.
Okay, right. So obviously what we're interested in, much as we're all engaged in the politics, is the outcome for investors. What are the risks there?
Yeah, elections are always a surprise, especially in Latin America, and especially the opinion polls are never really super accurate. As we know, there are some surprises there. I mean, one potential surprise is the third candidate at the moment that is called Ratinho. So he's a TV presenter, very controversial, very, how can I say, aggressive in the way he speaks as well. At the moment, he has 7% of the votes. But some opinion polls are saying that actually he could grow a little bit more because he does have some TV time and he's very well known in Brazil. So this could be a big surprise, I would say.
So Lula is really the sort of continuity candidate, is he, for markets? And markets would be happy with that, do you think?
Yes,
or are there
well,
risks to him?
both of them are kind of known to the markets, I would say, because one is the son of a previous president and the other one is the third-time president. So obviously, Brazil has built a lot of institutions as well. So the institutional framework is quite strong and solid. So it's very difficult to see crazy things happen in Brazil if either of the candidates win, to be fair with you. So probably going to sell off a little bit if Lula wins, mainly on the fiscal side, because Lula still has his agenda, his social agenda, which would involve a lot of fiscal spending potentially. But there are limitations to that because we have the budgets, we have a Congress, and the Congress is going to be even more towards the right. So it's this kind of a tug of war between the president, if he's left wing, versus the Congress, which is right wing.
But there is a lot of give in markets at the moment. I think the big thing that struck me about this story is you have inflation at about 5% at the moment. That's a success, obviously, for an emerging economy that's growing very quickly. But at the same time, interest rates are at 15%.
15%,
So that's
exactly.
a huge
Shocking.
sort of real return for investors, right?
And actually, inflation expectations are coming down. We are probably going to go below 4%, especially if we see the currency appreciating because terms of trade are still positive for Brazil. This year, we're not going to have, in 2026, we're not going to see a fiscal impulse because last year, a couple of things were approved that actually gave some fiscal impulse and helped consumption. But this year, we're not going to see, we hope not to see, because there are some limitations given that is election. The government cannot spend after the 6 months. So 6 months, everything he wants to do has to be now. If we see any depreciation of the currency, which is not in the books in the sense that there's no fundamental reason for that. But if there's any surprise on the tariff side, this could actually generate some depreciation of the currency and therefore some pass through to inflation.
And at the same time, just in general, I mean, the pitch for Brazil is that it's a dynamic developing economy that really has got moving.
There is a dynamism happening in the economy still, that probably from the regulatory measures that Bolsonaro took during his time, Paulo Guedes, when he was finance minister. And this is still actually bearing some fruits for Brazil. And we are still seeing growth happening. And I think this year as well. So we are probably going to see growth surprising us on the positive side. This helps the fiscal, but not necessarily inflationary.
Super. Andressa, thanks very much.
Thank you.
Patrick Graham there talking to analyst Andressa Tezine. Philip, inflation at 5% and rates at 15%. This sounds like a no-brainer. What's the catch?
Nothing is ever a no-brainer in emerging markets, we find, and investors are being compensated for certain risks in Brazil, namely political risks, as we've just heard. So an election coming up, there is uncertainty as to who's going to face off. So that is clearly a risk that is getting priced into Brazil. But of course, Brazil has interest rates at 15% at the policy rate level, because Brazil was actually responding to fiscal dangers at the time. And those fiscal dangers did central bank deem to have repercussions for inflation. So the fiscal dangers in Brazil are never far away. In an election year, there is clearly a scenario possible where the incumbents are trying to make the population happy by opening the checkbook and trying to win the election through some excessive fiscal spending. And we know from the way that Brazilian markets have traded in the fourth quarter of 2024, very negatively, that the market does not take well to the Brazilian treasury being very, very loose with their fiscal accounts. So part of the high interest rate relative to inflation is actually central bank policy in action, where the central bank reacted to a threat that they saw from the fiscal account. In fact, this is a story that we have debated here already for developed markets as well, right? If the fiscal is just too loose, then this has an inflationary impact. And we have seen in emerging markets, in Brazil specifically, how a central bank can react to something like this. But that leaves investors, as this scenario has played out with this super high real interest rate that in the end compensates for some of the risks. And we believe it is worth staying invested in this particular story.
And so where else? Where are the other interesting stories in emerging markets? The other economies that are standing out for you at the moment? Where are you looking?
We have liked for a while now, and perhaps for the first time, not for the first time, but for a relatively long time in my career, that we haven't looked at this country, that is South Africa. South Africa has suffered, particularly through the years when Jacob Zuma was the president, from extremely low potential growth. Some people perhaps even expected this to be zero negative for a period. But more recently, South Africa has seen a rebound in potential growth due to some structural reforms. But South Africa is also enjoying a very nice tailwind from current relative commodity price developments. So the gold price is on everyone's radar. Gold has had a spectacular run. Other precious metals have also traded really, really well. Copper prices are trading relatively well, whereas hydrocarbons are under some pressure. So the oil price at the moment, notwithstanding the recent rally on the back of headlines around Iran, the oil price is just structurally lower than it was over previous years. And if you compare South African exports, which are mostly in the precious metals area, with South African imports that are typically in the hydrocarbons area. It could be to do with like oil or coal. They still import a fair bit of coal to produce electricity. So if you compare these two, then it's very clear that the price performance of precious metals, metals in general, is much better than the price performance of hydrocarbons, which gives South Africa a huge boost.
Commodities, different emerging markets. Becky, you have the advantage of picking and choosing between these different asset classes. Are there other aspects to the EM story, however, that sort of continue to make you perhaps a bit more cautious? We've done very well on putting the buy argument here. Philip's done very well on that. But what do you sort of look out for as sort of red flags?
Geopolitical risk is sort of almost a permanent feature of our investment backdrop here. So bouts of volatility, even though we're looking at an asset class that's very attractive from the fundamental and valuation perspective, I think bouts of volatility can always come back, and so sizing is always quite an important consideration for us in a diversified portfolio. I think if we do get periods of stronger dollar and that tightens financial condition, that would be a risk for EMs for sure.
Is there a case at the moment for taking risk generally off the table then?
So in portfolios, we have positioned quite bullishly coming into this year, and that was mostly predicated upon we had more of a benign outlook to inflation, and we were not sort of true. We didn't really buy into this lower payroll is a genuine sort of imminent recession risk narrative. So for us, the environment looked a little bit more like Goldilocks than either sort of imminent recession or inflation taking off. Now we have to watch how this evolve, obviously. So what we've been busy with in January has been adding hedges, adding defensive assets, restriking our option strikes, to take a little bit of profit to lock in this performance, because we know that the only certainty is that there's a lot of uncertainty. So far, most of our portfolio have de-risked a fair bit, so we've fared reasonably well in the recent bout of volatility. Now, what we're watching before we re-risk meaningfully is where does volatility settle? Can we return to a volatility regime that is more well-behaved? It looks like there are tentative signs of that, and we have to watch, where this the dollar has sort of continued its downward trend. If it tried to break out a couple of times over the past few months, but it seems like it's resumed this downward trend. So if we see more stabilization on that front, and finally, as we've observed the last couple of days, the back end of Japanese yield curve caused a lot of havoc in global bond market, and in the late cycle environment, when you have bear bond curve steepening, that could be quite a threat to risk assets in general. It seems to be again stabilizing. So and arguably that was quite a thin market that could be addressed if the authorities have the willingness to address so, probably after the election. And so these are all risk factors that we'll have to monitor to get more comfortable with the risk market.
How does that read across to you, Philip? Are there areas where political risk is too high or perhaps not priced in your world?
Yeah, good question. In fact, we have a lot of elections in emerging markets in 2026, and quite a few of them will be market-moving events, no doubt. So Brazil was already mentioned. There's also an election in Colombia, which is of pivotal importance to that particular market. We have an election in Hungary that could also potentially lead to regime change in Hungary for the first time. This is in play for a long time. At the moment, this is not the base case for the market. The market thinks that the incumbents will take it, but there is a non-zero chance that a different outcome materializes, and in that case, Hungarian assets could really be quite strong. I would also highlight the fact that we have had in the last sort of year or two a lot of political risks that weren't scheduled. Most notably, of course, the most recent situation in Venezuela, which led to a pretty sharp move in Venezuelan bond markets, although there has not been a great deal of contagion outside of Venezuela. So in general, geopolitical risks just have to be constantly factored into decision-making in emerging markets, and 2026 is a fairly heavy electoral year.
Okay, thank you, Philip, and thank you, Becky. It is about time to draw things to a close. Just to come back to the original question that we asked at the top, what will falling US rates mean reform asset allocation this year? I think the answer, as we've heard today, might be to take maybe some more risk, be a bit more creative with those defensive plays, Becky, that you were talking about, and particularly looking very closely at emerging markets and that wide universe of options that you presented today, Philip, but always keeping an eye, obviously, on the political risks. So before we bring things to a complete close, we're going to play hotcakes and hot potatoes. What asset is looking tasty to you, and which would you be keeping a wide berth from? Becky, I'm going to start with you, perhaps, for your hotcakes.
I'm going to pick commodities. I think in a running hot environment and weak dollar environment, commodities could continue to thrive.
Okay, and your hot potato?
Probably investment grade credit spreads. We've been putting hedges on that space. Spreads are quite low. We think it probably has nowhere to go, and the issuance is likely coming strong. So we'd rather avoid that area.
Being caught on the right side. Okay, very good. Thank you. Philip, your hot cakes?
We still like countries with high real interest rates, so namely Brazil. We also like, for example, Egypt, which has a deflationary story to it. We also overweight in Turkish bond markets, which also have a pretty interesting carry profile relative to its volatility.
All right, and your hot potatoes?
Credit spreads in general are quite tight, and within credit spreads, spreads in Asia are even tighter than tight. So that is something that we're not overly keen on. It's extraordinary to see, though, how in every market sell-off these spreads actually don't tend to widen all that much. So it is a short, just because we feel that we have better opportunities, rather than on a very fundamental argument that these spreads shouldn't be where they are. There's a big technical argument as to why they are so tight.
Well, that is all we have time for. Thank you to our portfolio managers, Becky Quinn and Philip Fielding, and thank you also to our analyst, Andressa Tezine. You can find out more on the topics that we've discussed today on your local Fidelity website or at fidelityinternational.com, where you can also find our outlook for the whole of 2026, which goes into even more depth on what our investment experts expect in the year ahead. If you've enjoyed today's episode, please share and subscribe. The producers today were Patrick Graham and Rachel Reed, with production support from Connor Bailey. For now, from all of us at Fidelity, goodbye.